Look at your screen. Right now, in the middle of 2026, the global financial landscape is telling you two completely different stories, and both of them are lying to your face if you don't know how to read between the lines. On one side of the street, Wall Street is throwing the wildest, most expensive party of the decade. The Nasdaq Composite has just wrapped up the second quarter of 2026 with a jaw-dropping 21.4% gain, its single greatest quarterly surge in 6 long years. Tech giants are minting trillions of dollars out of thin air, and your passive index funds are glowing green. But just a few blocks away, in the unregulated digital alleys of the crypto market, there is blood in the streets. Bitcoin, the self-proclaimed king of digital gold and the ultimate hedge against inflation, has just suffered its worst monthly collapse in 4 years. In June 2026 alone, Bitcoin shed nearly 19% of its value, crashing straight through the critical psychological floor of $60,000 and leaving a generation of yield-chasing retail investors holding bags of digital dust. This is not just a temporary market wobble. This is the Great Decoupling. For years, the genius minds of Web3 told you that crypto and tech stocks were married at the hip, that risk-on assets rise and fall together on the waves of global liquidity. They promised you that when the institutions arrived with their multi-billion-dollar ETFs, Bitcoin would be propelled to the moon. Well, the institutions finally arrived. But instead of saving crypto, they built a bridge, marched across it, and looted the liquidity to fuel the most aggressive artificial intelligence bubble the stock market has ever witnessed. How did a policy of high-for-longer interest rates from the Federal Reserve create a historic stock market boom while simultaneously starving the crypto ecosystem of its lifeblood? Why did the smart money abandon the promise of decentralized finance to seek shelter in the mega monopolies of Silicon Valley? And, most importantly, who is paying the bill for this multi-billion-dollar rotation? Put down your ledger, forget the hype, and grab your ledger sheets. Today, we are exposing the mechanics of how Wall Street systematically starved the crypto Wild West to fund the greatest tech rally of our lifetimes. Let's dive in. To understand why Bitcoin bled, we first have to understand where the oxygen went. And in Q2 of 2026, all the economic oxygen in the world was being vacuumed up by a handful of office parks in Cupertino, Redmond, and Santa Clara. Let's talk about that 21.4% Nasdaq gain. In the world of finance, a 20% move in a year for a major index is considered an outstanding performance. To pull off a 21.4% gain in just 90 days is nothing short of an economic anomaly. It's the kind of momentum you expect from a highly speculative small-cap stock, not from a collection of the largest, most heavily capitalized corporations on the planet. So, what drove this monster run? The mainstream media will tell you it's purely artificial intelligence hype. They'll point to the endless press releases mentioning generative agents and neural processing chips and tell you that we are entering a new industrial revolution. But if you have a healthy dose of skepticism, you know that hype alone doesn't sustain a multi-trillion-dollar rally when the Federal Reserve keeps interest rates at their highest levels in over 2 decades. No, the real driver isn't just promise, it's cold, hard cash flow. Unlike the dot-com bubble of 2000, where companies with zero revenue were valued at billions of dollars, the tech giants of 2026 are absolute cash-generating fortresses. Microsoft, Apple, Google, and Nvidia are sitting on mountain ranges of cash reserves, often exceeding $100 per company. When interest rates are high, normal companies suffer because their borrowing costs skyrocket. But these tech monopolies don't need to borrow. In fact, high interest rates actually benefit them because they earn billions of dollars in interest income just by letting their cash piles sit in short-term government bonds. During the second quarter of 2026, corporate earnings reports did something extraordinary. They proved that the massive capital expenditures poured into AI infrastructure over the last 3 years were finally starting to yield real-world software revenues. We saw enterprise software companies reporting massive margin expansions because they successfully automated customer support, coding, and administrative pipelines. We saw cloud computing providers reporting record-breaking demand as every business on Main Street scrambled to integrate machine learning into their daily workflows. Wall Street looked at this landscape and came to a powerful conclusion. In an era of economic uncertainty, high inflation, and geopolitical friction, the safest place on Earth to park capital was no longer gold, government bonds, or decentralized tokens. The safest place on Earth was inside the balance sheets of big tech. This triggered a massive flight to quality. Institutional asset managers who had spent the last 2 years holding cash or defensive consumer staples decided to throw caution to the wind. They liquidated their defensive positions and poured hundreds of billions of dollars into the Nasdaq. Every single day of Q2 2026 felt like a relentless march upward. Every minor dip was instantly bought by algorithmic trading desks and retail investors using their automated retirement accounts. By the time June ended, the Nasdaq hadn't just beaten expectations, it had completely redefined what was possible for a mature stock market index. But, as the old saying goes on Wall Street, money is a finite resource. Every dollar that buys a share of an AI chipmaker is a dollar that has to be pulled out of something else. And the victim of this massive capital reallocation was sitting right in the digital wallets of millions of hopeful traders. While the stock market was celebrating its historic green quarter, the crypto world was experiencing a cold, damp, and incredibly painful June. Let's put Bitcoin's 19% drop in June 2026 into perspective. This wasn't just a quiet drift downward. This was a systematic liquidation event that shattered the bullish narrative built up over the previous 18 months. When Bitcoin dropped below $60,000, it didn't just break a technical support level on a chart, it broke the spirit of the entire retail trading community. To understand how this happened, we have to look at the silent forces that created a massive supply-demand imbalance in the market. First, let's talk about the elephants in the room, the Bitcoin miners. Following the halving event, the cost of mining a single Bitcoin had doubled. For the average mining operation in Texas or Iceland, the cost of electricity, hardware maintenance, and administrative overhead meant that their break-even price was dangerously close to $55,000. During the early part of 2026, these miners tried to hold on to their accumulated Bitcoin reserves, hoping for a post-halving rally to $100,000. But hope is not a viable business strategy when your power company demands payment in actual US dollars. As June rolled around and the price of Bitcoin began to stagnate, these miners were forced to capitulate. They opened their digital vaults and dumped tens of thousands of Bitcoins onto the open market to cover their operational costs. This created a massive, constant selling pressure that the market simply could not absorb. But miner capitulation was only half the story. The second blow came from an unexpected source: government treasuries. In June 2026, several sovereign nations, including the United States and Germany, began moving massive tranches of seized cryptocurrency from their law enforcement wallets to public exchanges. When a government wallet containing $2B worth of Bitcoin suddenly wakes up after years of inactivity, the markets panic. Algorithmic trading bots, detecting these on-chain movements, instantly began shorting the market, front-running the expected government sell-off. And then came the ETF paradox. When the Spot Bitcoin ETFs were approved with massive fanfare, retail investors were told this was the holy grail. The narrative was that Wall Street's trillions would create a permanent bid under Bitcoin, preventing any future deep bear markets. But what the marketing brochures forgot to mention is that institutional capital is highly mercenary. When the Nasdaq began its historic 21.4% climb in Q2, the institutional managers running these multi-asset funds looked at their dashboards. They saw a highly volatile, non-yielding digital asset sitting at $70,000, and they saw Nvidia posting 100% year-over-year revenue growth. The choice was obvious. Throughout June, we saw consecutive weeks of massive net outflows from the spot Bitcoin ETFs. Wealth managers and retail investors alike clicked the sell button on their brokerage accounts, converting their Bitcoin ETF shares back into cash, which was then immediately recycled into tech stocks. This created a brutal feedback loop. ETF redemptions forced the fund managers to sell physical Bitcoin on the spot market, which drove the price lower, which triggered more retail panic, which led to even more redemptions. By the time Bitcoin crashed through $60,000, the narrative of Bitcoin as digital gold was lying in ruins. Investors who had bought into the market at the top were left staring at their portfolios in disbelief, wondering how the ultimate decentralized asset could get so thoroughly crushed during one of the greatest economic expansions in stock market history. To truly understand the Great Decoupling of Q2 2026, we have to look past the surface-level narratives of miner selling and tech earnings. We have to look at the master architect of the global financial system, the Federal Reserve. For nearly 2 years, the consensus on Wall Street was that the Fed would embark on a rapid series of rate cuts. Market analysts predicted that as inflation crept back toward the 2% target, the central bank would lower borrowing costs, flooding the economy with cheap liquidity once again. This expectation was the primary fuel for the crypto rally in late 2025 and early 2026. Crypto thrives on cheap money. When capital is virtually free, investors are willing to take wild bets on speculative digital tokens. But in the spring of 2026, the Federal Reserve threw a massive wrench into those gears. Citing a sticky labor market and resilient consumer spending, the Fed made it clear that they were keeping interest rates higher for longer. They signaled that instead of the 4 or 5 rate cuts the market had priced in, they would hold rates at elevated levels for the foreseeable future. This policy shift completely re-engineered the global risk curve. Think about how a professional money manager or a wealthy family office evaluates risk. When the risk-free rate of return, the interest rate you get just by holding US Treasury bonds, is sitting at 5%, the math changes completely. If you can double your money in a decade with zero risk by lending it to the US government, your incentive to buy highly volatile assets like Bitcoin or speculative altcoins drops dramatically. To justify taking money out of a 5% risk-free asset and putting it into the crypto market, you need to expect astronomical returns. But with Bitcoin already trading near its all-time highs, the risk-reward ratio simply didn't make sense anymore. This is where the liquidity rotation began. The market realized that the total pool of global liquidity was no longer expanding. The Fed was actively keeping the monetary taps closed. In a world of stagnant or shrinking liquidity, you cannot have a simultaneous bull market in every single asset class. You cannot have real estate, oil, gold, stocks, and crypto all skyrocketing at the same time. There isn't enough money in the system to support that, so a choice had to be made. Capital had to prioritize. And when forced to choose between the unproven, non-yielding utility of decentralized protocols and the cash-flowing, high-margin utility of artificial intelligence monopolies, global capital chose the monopolies. Money began to drain from the outer edges of the risk curve. It started with speculative meme coins, which lost 50% to 70% of their value in a matter of weeks. Then it drained from major altcoins like Ethereum and Solana, which saw their trading volumes collapse. Finally, it hit the core of the crypto ecosystem, Bitcoin itself. As the liquidity drained out of crypto, it flowed directly into the massive balance sheets of the Nasdaq 100. Because big tech companies are essentially sovereign economic entities with their own massive cash reserves, they acted as a substitute for bonds. Investors realized they could get the safety of a cash-rich fortress combined with the explosive growth potential of the AI revolution. The result was a perfect economic transfer. The capital that was supposed to fuel the next crypto bull run was instead used to buy NVIDIA graphic cards and cloud subscriptions. Wall Street didn't just ignore crypto. They systematically starved it to fund their own technological empire. This macroeconomic rotation isn't just happening on institutional trading desks. It's playing out in real time in the living rooms of everyday Americans across Main Street. And it's creating a fascinating, highly polarized social dynamic. On one hand, you have the traditional passive American investor, the school teacher, the construction worker, the corporate mid-level manager. These are the people who don't trade individual stocks, who don't look at charts, and who have probably never touched a crypto wallet. Instead, they simply have a percentage of every paycheck automatically deducted and deposited into their 401k or IRA accounts, which are managed by giant mutual funds tracking the S&P 500 or the Nasdaq. For these everyday citizens, the second quarter of 2026 was an absolute blessing. They opened their quarterly financial statements in July to find their retirement portfolios sitting at all-time highs. The massive surge in big tech had single-handedly lifted the net worth of millions of middle-class households, providing a welcome buffer against the persistent sting of inflation on consumer goods. For the passive investor, the system worked exactly as promised. But on the other side of the demographic divide, you have the active, self-reliant retail traders. These are often younger Americans, Gen Z and millennials who grew up with a deep, healthy skepticism of Wall Street and traditional financial institutions. Having witnessed the financial crises of the past, they chose to take their financial destiny into their own hands, bypassed the traditional 401k, and invested heavily in the promise of decentralized assets. For this group, June 2026 was an absolute massacre. You see, retail crypto traders don't just buy and hold physical assets. To maximize their returns, many of them utilize high levels of leverage on unregulated offshore exchanges. When Bitcoin was trading comfortably at $70,000, these traders took out loans, leveraged positions of 10x, 20x, or even 50x, betting that the price would inevitably break upward toward the six-figure mark. But when the market doesn't go up, leverage becomes a financial weapon of mass destruction. As Bitcoin began its slow, painful descent in June, driven by the institutional rotation we just analyzed, these leveraged positions began to get squeezed. When the price slipped below $65,000, the first wave of margin calls was triggered. Traders who couldn't deposit more collateral had their positions automatically closed by exchange liquidation engines. This forced selling drove the price down even further, triggering the next layer of liquidations at $62,000 and finally culminating in a massive, systemic cascade that wiped out over $1. 2B in retail trading accounts in a single 48-hour window as the price collapsed below $60,000. The irony of this situation is almost painful. The very retail investors who sought to escape what they saw as the manipulated casino of Wall Street ended up getting wiped out in an actual, highly leveraged digital casino. Meanwhile, the passive investors who trusted the traditional system saw their wealth protected and expanded by the very corporations they often criticized. It is a stark reminder of a brutal truth in modern finance. The house always wins, and when the wind blows hard enough, the biggest trees in the forest, the massive tech monopolies, are the only ones that don't get ripped out of the ground. So, where does this leave you? Whether you are a dedicated stock investor, a crypto believer, or just someone trying to make sure your household budget doesn't get completely eroded by inflation, the events of Q2 2026 carry a profound lesson. The era of easy, predictable markets is over. The romantic idea that you can simply pick a side that you can be 100% Team Wall Street or 100% Team Crypto and coast your way to financial freedom is dead. The modern financial system is a highly integrated, shifting matrix of liquidity. When the regulatory environment changes, when the Federal Reserve shifts its posture, and when massive technological shifts like AI become highly profitable, capital will move with a speed and a ruthlessness that will leave passive observers in the dust. If you are a crypto investor, this is not a sign to abandon hope, but it is a loud, clear wake-up call to abandon the hype. You must look past the empty promises of social media influencers and audit the actual utility, structural demand, and institutional inflows of the assets in your digital wallet. You cannot rely on leverage in a market where sovereign entities and multi-billion-dollar institutions are actively playing a high-stakes chess game. And if you are a stock investor riding high on the tech boom, this is a warning against complacency. No market goes up in a straight line forever. The extreme concentration of wealth and performance in just a handful of big tech stocks means that the entire stock market has become highly vulnerable to any systemic shock in the tech sector. If consumer spending slows down, or if the promise of AI integration fails to deliver expected enterprise productivity gains in late 2026, the correction will be swift and painful. In this new financial reality, your ultimate weapon isn't a hot stock tip, a speculative token, or a government pension plan. Your ultimate weapon is your own financial literacy and individual adaptability. You must learn to read the macroeconomic signals, understand the flow of global liquidity, and build a resilient, diversified portfolio that can survive the storms on both sides of the street. The global trade war, the monetary tightening, and the technological race are rewriting the rules of wealth every single day. If you want to stay ahead of the curve, protect what you've built, and truly understand the invisible forces moving your money, make sure to hit that subscribe button, turn on notifications, and join our growing community of conscious investors. Now, I want to hear from you. Where did you stand during the wild ride of Q2 2026? Did your portfolio bask in the green glow of the Nasdaq, or did you feel the sting of Bitcoin's drop below $60,000? Let's talk about it in the comments below. This is the World Money Desk. Stay sharp, stay authentic, and we'll see you in the next deep dive.